Good morning. It's Thursday, May 23rd, about 6 a.m. Central Time. Overnight, the precious metals are still correcting after yesterday's sell-off. Usually, I would use the term bloodbath to describe the Wednesday price action with a 6% sell-off in copper, 3.3% silver, 1.8% gold. But the reality is that we were preparing for this moment. Let's not put it past us here. Many of you had been patiently waiting for a pullback to add and establish positions, while others of you had been actively trading in the market, raising those stop losses. For example, many people were raising the stops to yesterday's low on the gold market. They were clipped out. It broke out of the trading range, so now they're out of June gold, which is great because first notice date's going to be into next week, and they'll look to reestablish in something like August or September. While others of you had bought call options and call spreads to avoid having the FOMO of chasing and grossing up those markets near the top in preparation for a potential run to $50, $60, $75. Analysts are actually calling for $75 silver now. So an example of a tactical strategy that many of you can implement. 15 years ago when I ran the Strictly Options hotline for one of the largest commodity trading companies in the world, if a client, for example, was unsure about the duration of the move in a low volatility environment, like what we saw with silver where it was kind of coiling, or you look at some of the agricultural markets, they tend to coil, I would suggest something like a broader call spread that's calculated risk with 3 to 6 months out in any given commodity to give it time to develop. And that was something that we laid out and I put out as an example, if you don't know, on the Kitco article about a week ago. It was the August 35, 39 and a half call spread on silver. It was just for example purposes only, and I laid that out here, and that had seemingly exploded in value once silver got rocking and rolling to the upside. So again, not a recommendation. A different market that we're looking at here is crude oil. You have one of the lowest spec and fund net longs in 2024. Simply put, the money is trading elsewhere, and the market remains in a tight range between the 50 and the 200-day moving average. Most professional traders will scalp that range between that 50 and 200-day, while option traders, either on the long or the short side, will build longer dated calls or put spreads in anticipation that once the market breaks out of that range, that the move will be explosive once participants re-enter. Remember, people come in, the masses come in and chase. So right now you're getting this 2-day liquidation in silver. I kind of got the feeling that a lot of this liquidation here, because silver traders tend to be high beta momentum traders, that they are probably going over to the Nvidia, to the NASDAQ right now and chasing that. So I believe that like something like crude oil, once we break out of this range, it will be explosive. So the directional bias could be vary from commodity to commodity. And again, here's another example here. The second element that you want to look for, and I suggest many of you guys look at this because when you go into the Friday and into the weekend, a lot of you are still digging around looking for information here, trying to develop your master plan and your strategy. Look at the Commitment of Traders report, which shows you how long or short participants are. To wrap this up, I would look for something like a low volatility market with a high concentration, say record shorts, which are often found in grains and soft markets. Look at cocoa, one of the best performing commodities of the year, and that where the fundamentals can easily switch. So if you have coiling action in a commodity such as like corn, for instance, with record shorts in place and a sudden weather development occurs, all of a sudden you get a heat wave across the Midwest, or you get a two-front one where something's happening in South America where they're unable to harvest and our planting is strange, you could drastically see a change in the fundamentals leading to a short squeeze, and that's where call options and call spreads could be beneficial. So we'll continue to look at options in the silver market, as you don't necessarily want to catch the falling knife, per se, by putting on futures contracts directly because of their high leverage beta, but you can look at starting to nibble at things like call spreads, things that are going even farther out, such as like September 36, 38 call spreads, which could cost right around $1,000, have a $2 wide potential, which is $10,000 less what you pay for it. So again, an example, not a specific recommendation, but it gives you that 10 to 1, 8, 9 to 1 risk to reward ratio. So we're going to continue to monitor the developments here in the metals markets. Now, something interesting is that if Nvidia beats earnings, Nvidia cites stronger AI, cites that they're building even bigger, more complex chips. They're going to need more electricity to run. They're going to continue to strain the grid. They're going to continue to need to increase copper demand. And some other things that I was even thinking about is maybe even air conditioner demand. You're going to need ACs to cool all these different things.
Futures trading involves substantial risk of loss and may not be suitable for all investors.